One. And welcome everybody to another Smart Money Circle update. I'm Adam Sarhan. With me today is Keith Larkin, who's Managing Director and Principal at Robertson Stevens, and firm-wide they manage over $4.5 billion. Keith, thank you so much for coming on the show.
It is my pleasure, Adam. Thank you for having me.
So Keith, I always like to begin. Can you tell us a little about your journey and how you got to where you are today, please?
Sure. It's one that has taken a couple of different paths to lead me to where I am today. But when I did start out in the industry, I was actually on the sales and service desk for a mutual fund company. And I was assisting and fielding calls from outside financial advisors regarding the mutual fund company I was representing. And so I was unsure getting out of college because there were so many avenues within finance. That's such a blanketed term that I wanted to see something that would give me a lot of exposure. And so instead of going down the route then after being on the sales and service desk of being a representative of a mutual fund company, I wanted to work directly with clients. That's where I felt my passion would be. And so ended up after the sales and service desk, worked for one or two money management firms on their private client side, and then finally made the jump when I worked with Deutsche Bank as a true financial advisor. So one of the things that I think can be scary when you're getting into this industry is that as a sole practitioner or even on a team, you are 100% commission. And so I went the route of working as on the money management side, on the private client side, because that was a little more stable from the income. But then when I felt I had the confidence to hang my own shingle, so to speak, within a larger firm, I made that choice. And so again, the passion really was working with clients and trying to help them with solutions that I saw some clients had some pitfalls on. And so it really drove me to want to work with the high-end clients.
So I'm going to get excited here. Tell us a little about your investment strategy, please. I know you do options, you work with people that have IPOs, all this fun stuff. I'm all ears.
Correct. Great. So my strategy, like my journey, has evolved. And as technology is involved, I think it's important to embrace that. And so working with clients, we at the firm, and the firm is really good at helping with the wealth planning. I think everything that I do and the firm does starts with a wealth plan. So that's the blueprint. That's the the roadmap to where we want to go. So you can't just come in with a client situation in a meeting and just say, here's a great portfolio for you, because you don't know what they're trying to accomplish. So it really starts with assets, liabilities, and then getting into kind of like dating. You have to ask a lot of questions on your first and second dates before you get married. And so before we provide a final solution, we want to uncover what clients are looking for. And so being in the Bay Area, we do see a lot of technology clients that have concentrated technology positions. And so working on hedging out those positions, whether we're using options or an exchange fund, there are a lot of different strategies that we can employ to help clients with that. I do work a lot with options for certain clients for income generation, and that would be selling covered call options. So selling an option on a stock that we already owned and letting clients receive some income if the stock was right away, and then the stock potentially could be taken away at a higher price. Conversely, we'll sell put options. So if a client identifies a stock they would like to buy, but maybe we want to own it at a 10% lower price, we'll get paid premium for that. That's a unique and kind of a niche part of what I do. A lot of what I do too, though, is the belief in asset allocation, knowing that the 92 to 94% of a portfolio's return is based upon asset allocation. So not whether you own GM over Ford or Coke versus Pepsi, but really being in the right asset classes at the right time, and then making subtle tilts into the exposure the client has based upon the macroeconomic environment. I do believe in combining both active funds with exchange traded funds or ETFs and being more index based. And actually, the more that I'm reading, and again, with technology being as it is, going to more of a direct index approach for a good portion of a client's portfolio is something that I've been starting to implement more. And a direct index, just for those that don't know, you're basically replicating an index. So let's just call it the S&P 500. you can provide clients a return minus a small fee, a performance of that index, but you can buy individual securities that represent the index, which allows the manager to harvest losses. So as we know, in any type of business, or what you earn, it's not what you earn, but what you keep. And so tax sensitivity is extremely important. And so if we can harvest losses to offset any gains, that's the strategy. And that also helps with clients that maybe are selling real estate down the line, or they do have a concentrated stock position that they represents a significant portion of their wealth and they want to diversify. And so, again, being able to provide some tax alpha is very important.
Love that. So let's talk about the options for a second, in case listeners want just to dive a little deeper there and get some clarity.
Yeah.
Let's say client A owns, I don't know, let's say 10,000 shares of XYZ. And then you mentioned two strategies, the covered call strategy and then the put strategy. So the covered call, if he has, let's say 1,000 shares of XYZ, just keep it easy. Every call option would be 100 shares. So if he sells one call option at a higher price, one of two things happens. Either they buy the stock from him at that higher price, or they pay him a premium and then he owns the stock if the stock is below the strike price by expiration. Is that correct?
So a little subtle difference there. So the client will keep if we're selling a call option, the client's going to get the premium up front. That's theirs to keep, regardless of what the stock does. Mm-hmm. So the stock could exceed the strike price that we set, which at that point, the stock could be called away from us, so sold, but we've already agreed that if it goes above a certain price, we're willing to sell it. Third thing could happen, though, the stock could stay below that strike price, expire worthless. You've already still kept your premium, and we'll just sell a call option again further down the line.
Or income along the way.
Exactly. So that's why we're using it more of an income strategy, and we're letting the market dictate when the stock gets pulled away. So instead of working with the client, we can read the analyst reports, but we'll say, okay, if 1 month the stock has appreciated 10% and we're willing to let that go, let's not be greedy. That seems like a good return for 1 month. We'll do that.
Got it. So the client can't sell the stock below the strike price. So it's a predetermined level that, hey, I'm going to sell it at this price, 10% higher, or whatever number is set when you sell those call options.
That is correct.
Okay, got it. And then they're selling 100 shares at a time, depending on how many contracts that they want to sell for the call options.
Absolutely.
Yeah. So they can't lose all their stock. Nothing, that
they can only get called away how many contracts we've written. And on a side note, you could close that. You could buy back that position as well. Let's just say you didn't really want to sell it. You've had a change of heart. You could take some of that premium you received and potentially just buy back and close out the option and be free and clear.
Now, the other side would be selling the puts. So I'm assuming that's okay, great. So you sell the puts, stock's at 100, you want to buy it at 90. So instead of buying it at 100, you just sell the puts at 90. Let's say they expire next Friday. And then by next Friday, one of two things happens. Either the stock is below 90 or it's above 90. If it's above 90, they get the premium.
So they're going to
either way get the premium, right?
Sorry to interrupt you. So just like the call option, as soon as you sell the put option, client gets the premium. That's theirs to keep.
Got it.
And then, like you said, if the stock by expiration is below the strike, they will be put that stock, meaning they're going to own it. Or if it expires above the put price, well, then it just expires, what we call worthless, and we can do the same strategy, the next week or whatever time period we want.
The logic would be, let's say it goes to 95 and it stays at 95 and you keep selling the 90s, you keep collecting that premium week in, week out, week in, week out. And if it goes down, let's say to 80, you're going to be long the stock or you own the stock at 90. Is that correct?
That is correct. And so, one of the downfalls that you need to really be careful of on either side, though, is if it's a dividend paying stock. So for clients that are doing this on their own, make sure you're aware of dates, like an earnings date, which could cause the stock to have a little more volatility and movement in either direction, or if it's paying a dividend and someone on the opposite side of that trade wants your stock because they'll get the dividend before it goes X, just be cognizant of that. That's something that you want to make sure that you don't miss out on your dividend.
That's really, really helpful. Thank you, Keith, for that. So basically, the client comes to you, you figure out the plan, like dating, you ask those questions, get to know where they want to go, what their goals are, what their direction is, and then create a custom portfolio based on their wants and needs and goals and desires and objectives and all that fun stuff. Is that correct?
That is correct. Absolutely.
I love it. Okay, next question. Risk. How do you handle risk, and what are some mistakes you see people make with respect to risk management?
Handling risk is not done through a 10-question questionnaire that seems to be very popular in the industry. It really is trying to use years of experience with being almost a psychologist. And I would suggest, people that are wanting to become financial advisors, you're also going to become a counselor. A lot of times we know money is very emotional. And so you're going to have to read through the lines and the body language. Sometimes clients will come in and say that they've got a high risk tolerance, but you can tell from talking to them that if they saw a 10% correction in their portfolio in a month's time period, they would lose sleep over to that. And so obviously our job is to really mitigate the risk, get them an appropriate return, but really dial in on the risk. And you cannot have the return discussion of a portfolio or even just a single investment without addressing the underlying risk. That's first and foremost. And so you've got to be able to create a portfolio for a client that really suits what their ability to handle market gyrations are. So no one has any fear of risk in a bull market. And so, that's sometimes people have short memories. They forget maybe the correction in the beginning part of the pandemic or in 07 and 08. They just remember the good times like we're seeing right now. And now's a great example because if you're looking at just say the Standard & Poor's 500, which year to date is up around 12%. There are really about 7 or 8 stocks that are contributing to that performance. Some are calling it the Big 8 or the Magnificent 7, depending on which ones you want to put into that. But they're really tech stocks. And so if you extrapolate those out of the performance of the S&P 500, you'll notice that the S&P on any given day for a year-to-date performance is either slightly up, slightly down, or flat. And so that's something that you want to be cognizant of because as price to earnings is important, looking at the multiples and valuations of a stock, if that comes to more of a normalization or a mean reversion, you're going to see that pullback. And so it's very easy to say, well, I own Tesla and Amazon, so I'm great and I'm diversified because one's a consumer discretionary and one's an automobile maker. But when you have to peel back the layers of the onion, you really need to address the risk in the portfolio.
I love that. Yeah, that's so true. We just met, Keith, but there's so much you're saying that's just my brain's going on overdrive here. The psychology part, I literally wrote a book. It's called Psychological Analysis to Investing. It was #1 on Amazon for 2 straight months. And in it, I noticed you have a hanger in your closet. I have a hanger here, and the idea is to make rational, not emotional decisions with your money. And the best way of doing that is thinking about hangers in your closet. Nobody is emotionally attached to their hanger, but we're all emotionally attached to our money. So I use that as an example. And I love the fact that you have a hanger there. So, you're spot on with what you're saying based on my journey thus far and your journey. There's a lot of congruent things here. So as far as timeless lessons, let's talk about that. The next good segue for the next question. Can you please share some timeless lessons with the audience that you've learned along the way?
I think I'll piggyback on an answer I just kind of said, and that's really being more of a counselor and working through also family dynamics. It's important to make sure everyone is on the same page when it comes to the financial landscape. And so it's important just not only to talk to the end client, but maybe to talk to a trusted family member as they age, working with the next generation to make sure that from an estate plan, and a wealth plan. So not just the investments. And I think, investments are just one part of what a financial advisor should be bringing to the table, whether that's asset protection, retirement planning. There are differences in a client inheriting an IRA or what is called an inherited IRA, which are 2 very different things. And there's a very different tax structure to that. But there's a subtlety in the name that a lot of people just may not know about. And so I think it's really trying to encompass everything that wealth planning is involved. I know it's fun and there's a lot of sizzle to talk about options or, direct indexing and portfolio construction. But a lot of that can be opinion. And I think you need to also incorporate the rules-based and facts-based part of planning, whether that's, again, tax planning, designation benefit planning, making sure that you have a proper designations, and encouraging clients that do not have a trust, particularly here in the state of California. You probably don't want to have your assets go to probate and let the state determine when your beneficiaries get the assets, what it's valued at. And so it's really, I feel, making sure that you have the robust knowledge base to complete the journey for the client.
That's really, really powerful. So how about the other side of that, timeless mistakes?
I think rushing, I'll piggyback on what I just said, maybe rushing to judgment earlier in my career to want to just talk about the investment side of things and want to talk about a great mutual fund that you uncovered or a great strategy that would be perfect for them. But being excited, I think when you're younger in your career, you want to share your knowledge base. And so you want to get very technical. And a lot of times maybe you're not listening. And that's really the key to the job, I feel, is you have to listen, you've got to interpret, read between the lines, and make sure that you have that proper plan.
Love that. And then let's talk about some advice. What's the best piece of advice you'd like to share with the audience or give your 30-year-old self?
That's a great question. A piece of advice, slow down. Don't be so quick to, again, and I'm trying not to beat this dead horse here, but again, don't be so quick to try to prove your knowledge. And again, focus on one pillar of the many pillars that are wealth planning.
I love that. Slow down, take your time, and get the holistic 360 approach, not just, the stock du jour, whether it's Tesla or Nvidia, whatever. Yeah,
exactly. And I think, you have to be humble, and be humble to make transitions. And perhaps, for me, it's, becoming more of an advocate of indexing. After reading a lot of Charlie Ellis books, you can see that, active management, you've got to pick the right manager, but you also have to pick them during the right time, because history will show an active manager over a 15 or 20-year period may not outperform its appropriate benchmark. And so if you want to be consistent with clients, perhaps indexing might be a better way to execute that wealth plan.
Well, Keith, thank you so much for coming on the show. What is the best way for people to get in touch with you?
Oh, they're happy to respond by email or by my phone. So my email is keith.larkin@rscapital.com. That's keith.larkin@rscapital.com. They can also find me on the Robertson Stephens website. And also phone number is 415-606-9877.
Well, Keith, thank you so much for coming on the show.
Thank you, Ed. I really appreciate it.